Hi, everybody. Welcome to My Favorite Mistake. I'm Mark Graven. I'm joined today by Stephen King, and he probably gets this a lot. And before the audience gets too excited, I'm sorry, not that Stephen King. But this Stephen King is really interesting and has a great perspective for us. I'll introduce him in a second. But Stephen, thank you for being here.
Thanks,
How are
Mark.
you?
I'm wonderful. Thanks for having me.
So Stephen King is the founder, president, and CEO of a company called GrowthForce. They are one of the nation's largest outsourced bookkeeping, accounting, and controller services for companies and nonprofits that use QuickBooks. So Stephen has quite a background as an entrepreneur. He has a degree in accounting. And one thing I thought was really interesting, Stephen, before we get to your story, looking at your background, real early in your career, you were CFO of Amnesty International.
Yeah, that was fun. I got to do that for 7 years. I was a volunteer first for 3 years, and then this is a God thing. I was at Ernst & Young, where I was a manager of accounting system design. I had just given 2 months notice to go start my own CPA firm, and they hired Ernst to be the auditor. And Ernst didn't have a lot of nonprofits, didn't really want the account, so passed on the audit. But I ended up doing some freelance work, and then they asked me to run for everything that was not related to human rights. So I was in charge of fundraising and finance, and it was really great. And I did it 2 weeks after Bruce Springsteen and Peter Gabriel and U2, Sting, all did the worldwide Human Rights Now tour. And Amnesty grew from 6 million in revenue in the United States to 18 million in a year and a half. I came in 2 weeks later and had to design all the systems. So it was a great labor of love.
So even though as a nonprofit, there was experience and lessons to be learned about high growth situations that I'm guessing served you well.
Sure. Yeah. I mean, you got to be able to make sure you're measuring the outcomes that are furthering your mission. And I learned a lot about nonprofit financial management and how do you use the data to show the donors the tangible results of your gift. Because if you can do that, you'll raise a lot more money. So, that's really what we do more nonprofit work than anything else. It's about 20% of our business.
Oh, cool. So we'll talk a little bit more about GrowthForce and some of the things that you do within the company. But thinking personally, Stephen, thinking back over your career and your different experiences, what's your favorite mistake?
Well, I've been doing this for 40 years, and it wasn't until the last decade or so that I really started to understand how to build what I'm worth and how to get the client to feel good about that, right? To have our long-term relationships with people where you're really making a difference and you're contributing in a way that allows you to live a lifestyle that justifies all the hard work and hours of being an entrepreneur. And, I started this, when I left Ernst & Young, I started my own CPA firm, and I hated it. I was billing $45 an hour. I thought, I was $175 an hour a month before at Ernst & Young.
Yeah.
This is back in the 80s. And I just couldn't justify in my mind charging anybody more than that because I didn't understand the value. And I also didn't understand how a small change in pricing has a profound impact on your profitability, on your bank account. And I used to think, this is over a couple of decades, had my own CPA firm, hated it. Amnesty became one of my clients. I went over there full time for 7 years, built out that system. And then Netscape 1.0 came out in 1995.
Right.
And I started a company called Virtual Growth. We ended up raising 43 million in venture capital funding. But the big question here was, how do you price your services in such a way that you can make the margins that you need to make in order to cover your overhead and then generate profit and some cash flow? And in the early days, especially when I was just me, your whole relationship with money comes into play, right? It's like, your self-worth and how, what you think something's really expensive may not be what the other person thinks is expensive, or vice versa.
Yeah.
That lesson, to start was, hard because you're the widget, right? You're doing the work. But most I see with most of our clients is as they get bigger, we get to $1 million in revenue. And if you're not making 15% profit, you struggle and sit there and say, if I in order to get to the profitability I need, I've got to sell more. Mm-hmm. And that's the biggest mistake that I see that business owners make. They think they can sell their way to profitability. Mm. And it's only true if you're pricing right.
Yeah. If you don't have good margin, why do you want to do more poor margin work, basically?
Exactly. And it comes from a fear of, well, first, I think it comes from a not understanding how profound an impact a small change in pricing has on the bottom line. Mm-hmm. I just did an exercise this morning with a $2 million business. Their average client's, about $100,000, and they think they're getting, 40% margins. But the reality is that a third of the time, the sales reps come in and say, I'm in a competitive situation here. I got to be able to offer this 10% discount, and I'll close this deal, and we'll make it up down the road with services or parts or warranties or referrals, or I'm keeping a competitor from taking the business, or I got people sitting on the bench. Let's get them busy. All these things that make you think like, just close the deal.
Sure.
I used to always say yes to that salesperson. Yes, I got people sitting around on the beach. And what happens is that destroys your business.
Yeah.
We have an impact of discounts calculator that shows if you have a 40% margin and you give a 10% discount, you got to sell 25% more sales just to make up the discount.
Wow.
And your profit, all that discount comes out of profit. All of it comes out of your bank account. Conversely, if you can increase your prices by 10%, now you can sell 20% less. You can take Fridays off.
Yeah.
And that's the secret. I found that simple thing. Now, it's hard. A lot of people, we're accountants. Everybody says they do what we do. Now, GrowthForce, we do management accounting, right? So we're trying to give you data that's actionable to make decisions. But before we figured out that value that we had, we were accountants 20 years ago. We were just doing bookkeeping and accounting and taxes. I'm a CPA for 35 years. That's a commodity now.
Yeah.
And so it was hard for me to go in and say, I got to increase prices. But what we did was we created this methodology of, and I learned it from a value seller, the consultant, who said, what you need to do is first really understand the value that you're delivering.
Right.
And so what we do is we set up automation. We use QuickBooks is our core product. Mm-hmm. The reason QuickBooks has 88% market share is because it's so powerful. But most people only use it like they use Excel, right? To add, subtract, multiply, and divide.
Guilty, yeah.
Yeah, right? It's easy. But you have the ability to allocate your labor costs, which we do service businesses and nonprofits. That's all we serve. And in both cases, payroll is the biggest expense. Labor cost is by far your biggest expense.
Sure.
And so once you know how to allocate your labor costs and track the direct labor, the labor that the customer was directly paying for, the real cost to deliver your services, and move those direct labor costs above the line into cost of goods sold. So what cost of goods sold is the direct cost to serve the customer. There's only two parts. There's direct labor and direct materials, the stuff you have to buy to serve the customer.
Yeah.
Then you can subtract your revenue minus your cost of goods sold and see gross profit percentage. And that's the most important number on any P&L, any management report. Because gross profit creates net profit. And if you can take the bottom 15% of your clients, and this is where the value consultant came in, he said, give them an option. Give them three choices. Show them the real value and the costs of what they're getting, and give them a fee and say, I have to increase my fees in order to keep you as a client to X dollars so that you get them from the bottom 15% to the top 15%. Or here's a list of all the things that we're doing for you. Right. You can see it. You guys want to stay within your own budget, what we currently have. You can pick and choose, and we can afford to do 80% of this or whatever the ratio is. Or third choice is, I need to transition you to another service provider. And that's hard.
Yeah.
That's hard to fear. What if I lose this account? And what's happened is I've got literally decades of experience showing business owners that I've got one company right now, it's a $30 million business. It's making 2% profit. We're going to help them get to become a $20 million business with 15% profit. And he's like, I'll take that all day long.
Right. Well, so that's demonstrating value, and that's what I hear you saying, Stephen, is demonstrating how GrowthForce is differentiated. It's not just a commodity. Well, you could leave us and get the exact same service from someone else,
right,
a little cheaper. You don't want to compete that, based off of being a little cheaper.
And that's my favorite lesson, right? Once you understand what your real value is, and you can see it. If you do that job costing, if you take the labor costs, instead of, most businesses, their income statement has got an alphabetical list of their expenses, right? Advertising and accounting and bank charges, and then 3/4 of the way around all the P's are together, and it just says payroll taxes, maybe officer's salary or bonuses. But if that's your biggest expense and you've got it all lumped into like 2 or 3 accounts, you can't make data-driven decisions. You got to allocate that based on the work that they do. And what's great about QuickBooks is they own a time tracking system called T-Sheets that it's magic. If it has geofences. So when we do project-based service businesses, our specialty. When somebody shows up on site, it automatically says, "Oh, you're at the ACE, Dream account. Are you ready to start your timesheet now?" And it tracks it. Then when you run the payroll, it's either Intuit payroll or Insperity payroll, have it automated where you can allocate that labor cost based on how they filled out their timesheets. Now you have that data to show the value, to make the pricing decision. Yeah. It's pretty cool.
So it seems like, at this point, you've got the benefit of all this experience. It seems really clear to you about some of these mistakes you've made or things you've learned to do better. When did it really start to kick in? Like was there a single epiphany, or was it gradual where you started to realize you needed to take a different approach to pricing?
When I really started to focus on profits and not sales. When I realized you can't just sell your way to profits. We have 62 people, and when we were 15 or 20, and I was trying to increase the bottom line, all we did was focus on how many leads can I get in? How many new proposals can I get out the door? And how many closed sales can I get? And if I got to give a 10% discount to close that deal, go for it. And when I started to study the unit economics is the profitability of whatever shows up on your income statement. Your unit is whatever shows up on an invoice. The unit is what you put on the invoice, right? What's the profitability of that? Not what's the sales, what's the gross profit? Gross profit percentage is the most important number because it allows you to compare all your different services, all your different clients. I look at gross profit by sales rep. I want to see which of my sales reps are selling me as a commodity and trying to offer the 10% discount. Which sales reps really understand the value that we're delivering and can get that extra value. Now, once I started seeing that, I lost my fear of having that difficult conversation. I lost that fear that I wasn't worth it, that value of my own services. I could see the data and say, I got some clients here that are, highest margin, and these ones at the bottom, if I can swap them out for more like the top, all the extra cash goes right to the bottom line. That was the epiphany.
And that whole idea of what you're talking about, salespeople wanting the discount, let me close the sale, is something that's probably in their short-term incentives. If they've got a quota and they want, or they're getting compensation directly based off of sales one way or another, versus the long-term good of the company, right? So one company I've been fascinated by and have studied for a long time is Toyota. And they have a set of 14 management principles. Principle number 1 of those 14, I think you'd be interested in, Stephen. I'm paraphrasing it, but it basically says, make decisions based on the long term, even at the expense of the short term.
Wow.
And for all the companies that try to copy or emulate Toyota, that principle number one is probably the most difficult to copy.
Yeah. Yeah. And Mark, you really hit on something. This is another common mistake. I do a lot of speaking. And what I often say is, one of the mistakes people make is they measure the success of their salespeople based on sales
Instead of profitability.
instead of gross profit. Right.
Yeah.
And so if your incentive comp is designed to be able to give your sales rep a higher commission for that enhanced bonus, you go in there and you say, okay, this is the minimum. This is the floor. You can't sell below this. But if you can increase it above the floor, if you can identify the values that we can deliver to this prospect, then you'll make more money on the extra piece. Then everybody wins, including the prospect, because that sales rep is now incentivized. Not just, it's like, there's a famous study. I read the book. It's about big data. So the realtors are not designed to help you sell the house with the highest amount of money.
Right.
It's to sell the house as fast as possible.
I think that study said realtors, when they're selling their own homes, get a certain percentage higher price than when they're selling someone else's.
And if you yourself sell your own home, you beat the realtor all the time because your incentives are different.
Yeah.
So it's Freakonomics. It's in Freakonomics is where I read that.
Yep. It's been a while, but yeah.
So yeah, you're right. So if you incent the sales reps based on a gross profit percentage, then you get everybody in the company focusing on the most important measure. What management monitors gets done. Gino Wickman wrote that in Traction. What management monitors gets done. What do you want to get done? If you want to increase net profit, start by focusing on increasing gross profit.
And it sounds like, trying to grow the company by selling more probably just speeds up the hamster wheel, if you will.
Yeah, exactly right. You create. That's why often you see high growth companies have cash flow problems. It's not just fueling the investment to handle all that work. It's if you don't really understand pricing is the most important decision you got. If you really don't understand your above the line costs and what your overhead is, what is your nut? How much do you have to, this is what we suggest. You take your overhead for the whole year. Let's say you got $1 million, right? And you look at how many units, how many jobs, how many customers, how many widgets, whatever you're going to have per widget, per job, per customer. Let's say it's 10,000. That means each job has to cover $100 worth of overhead. And if your gross profit doesn't have that percentage of overhead in it, you're never going to be able to get to your profitability. And then you say, how much profit do I want to make? If I want to make $1 million in profit and I got $10,000 jobs, I need $100 worth of profit in the bottom line in each job.
Yeah. So, again, our guest is Stephen King. He is the CEO of GrowthForce. And one other thing I wanted to touch on, you talked earlier about having the client feel good about the price increase and how you make that happen. Because I can think of times, this is the time of year, we're recording this in January, where all sorts of businesses that you may have an ongoing relationship with will hit you with an email or a sign. And a lot of what bothers me is when it's stated in terms of something like, well, we're in the new year, it's time for our annual price increase.
Right. I hate that.
I start cursing under my breath.
Yes.
Or when it's just framed as like because of such and such, we are forced to increase prices. And I tend to question that. I'm like, well, that's your choice. But I wonder if that ends up like in the short term. Curious what your experience is or what your recommendation is of how to make that palatable so that the customer doesn't find an alternative as soon as they can.
Yeah, I think first is transparency. If you really understand those above the line costs and you can actually show them how much time it takes and explain to them, what the things are that you're doing. When you're in a service business, you hire servants, people who like to serve. I'm a servant. I love serving my clients. Nothing more than I love that call today to talk about that business, about how to help them make more money.
Mm-hmm.
Your staff often think, okay, I'm going to do a really good job. When my client calls up and asks me for extra stuff, I'm going to say, sure. And I'm going to do it for them.
Mm-hmm.
Because if I make my client happy, I'll make my boss happy. And if my boss is happy, my life is happy. And that time leakage kills you.
Mm-hmm.
When you overserve the client, it kills you because it erodes your margins. And that comes right out of your bank account.
Yeah.
And so if you go to a client, you say, look, here's what the deal is. In order to make this account make economic sense for both of us, here's what we need to do. Let me show you what we're doing that's out of scope, or that I honestly, I missed it on the proposal. It's the kind of things like, how much time do we spend on emails, phone calls, client interaction,
sure,
project management, quality control. It's the hidden cost of an account. We see typically it's around 20%. And so if you're able to say to a client, look, here's the reality. I have this pricing model that we're implementing, that we have to implement in order for the business to make sense, because we can't continue to do it as is, or we were not going to be here for you. Mm-hmm. But it's not a take it or leave it situation. Give them 3 options. The second option is, we can stay in your budget, but 20% of this list has to go because we're spending a lot of time on emails, phone calls, project management, quality control that we're not getting, is not included in the value you're getting.
Yeah.
And most of the time, over 80% of the time, and I've been doing this a long time, I've got an IT company in New York who has one of the top technology companies that, one of those S&P companies that are lifting up the S&P right now in the last year, brand name that everybody knows, top 20 worldwide company as their biggest client, 40% of their business. Mm. That client was not covering its share of the overhead.
Yeah.
And definitely not generating profit. It was dragging down all the other profits. And usually it's the largest account that you have. Why? Because they have buying power. Yeah. They get the most expensive people in the company. Management, the founders are working on their biggest account. And the company says, jump, you say how high? And what happens is, and we see this regularly, we have to go to the clients and say, if you want to increase profits, we have to give them those 3 options. And they're like, oh my God, what if I lose giant technology client? It's on our website. It's how we, it's our identity. And if the clients are happy with you, if you're doing good work, and you can be transparent and show them what they're buying, over 80% of the time, the clients will say, of course, we like you guys because you have such good project managers. We like you guys because you do quality control. Yeah, no problem. And what we found is, when we do that with clients, this particular client, they tried to sell their way to profit. They got to $6 million in revenue, barely breaking even. We repriced the giant technology company. They were like, oh my God. They said, yes. We showed them. I said, look, even if you lose them, you'll actually make more profit as a smaller company. You're better off being a $4 million business, making 15% profit, than a $6 million business breaking even. Mm-hmm. That's what convinced them. I was like, okay, yes, you're right. Now I'm not afraid to lose them.
Yeah.
And they said yes. And then they went to every one of their clients and said, look, I got to increase fees by 20% because I got emails that our cost of project management, travel time. And we showed the details. All 100% of their clients said yes, because they gave them those 3 options. They either lowered the scope or they increased their fees.
Yep.
And they made $1.5 million in revenue at the end of that first year on $6 million in top line.
Yeah.
So
$1.5 million in profit off of $6 million revenue. Yeah.
25%.
Yeah.
Because they just value priced everybody, and they realized that it's not how much you earn, it's how much you keep that matters. And when they shifted that focus to looking at gross profit percentage and everybody in the company focusing on it, the whole business model changed.
Yeah. Well, it's great that you and the team at GrowthWorks get to help companies like that. And I can see where you're coaching them through something that seems really risky, really scary. So to have somebody with experience and examples to point to say, I feel pretty confident this will work, that I'm sure that means a lot.
It's data. You're making a data-driven decision, and there's no hiding from the facts, except in politics.
So let's talk about one other question about GrowthWorks. I'm curious if you talk a little bit about company culture and values. Our big theme here on the podcast, of course, as you've talked about, is learning from mistakes. How's that an important part of your culture? What have you learned about that?
Yeah, I mean, it is the most important part of our culture. We have we're an Insperity client, so we learned a lot about 8-9 years ago. They came in and they helped us with the human capital strategy. What that basically meant was they helped figure out what are the behaviors that are successful in your business. They actually asked me to point to the employee that is the most like the kind of employee you want to point to, and I pointed to right away Marcia. She was a bookkeeper. She was going to school at night at Lone Star College and working for us full-time during the day, but she was accountable. She was a problem solver, and she loved her work. And we came up with our core values, which is we have SNAP. It's a smart SMART. We have SNAP. We're problem solvers. We have meaning our employees, we hire them because they love serving small businesses and nonprofits.
Yeah.
They are accountable. They do what they say, they would do what they do, and they're resourceful. So they'll find problems, and they like working in a team. Mm-hmm. That accountability piece is really the most important of them all. And it's not just you do what you say what you'll do, is that you embrace the idea of open, honest communications, mm-hmm. especially around difficult issues. Right? I'm a New Yorker from an Irish Catholic family where you knew exactly. My mother at a young age said to me, is like, if your friends don't tell you your breath stinks, nobody will. Go brush your teeth. And so by having that kind of open, honest communication, one of the things we kind of brand ourselves as is a learning organization. And what that means for us is we want to celebrate and learn from every mistake. We just made a $22,000 mistake and have a lot of lessons about not going into a new vertical industry, because it's like, you know what, that's not going to be good for us. But we pulled the trigger on the first account. It was like, you know what, let's not expand there. But what we do is, and I used to do it in the early days of GrowthForce when, we were 10, 12, 15 people, and I was no longer able to see every account and every job. What I did was I created an award, which was the best mistake of the month. And what does the best mistake of the month mean? It's the one that we can fix and have the biggest impact on the business. Yeah. And I remember Jennifer Brown, who's still with me, and Marcia Gibbs, 8 years later, is now our director of onboarding. Jennifer was like, I've never been in a place that celebrated. I got a gift card for $50 for making a mistake. And I said, it's because I want everybody to feel like, okay, hey guys, I just learned something here and I want everybody to know about it. And what we did was, she fat fingered a sales tax payment mm-hmm. into the tax software. And they don't come back to you and say, oh, you entered the bank account number wrong. Mm-hmm. They just tell you the next day that the payment didn't go through, and therefore now you owe a $2,500 sales tax penalty. Yeah. And so by learning that after the first mistake, you avoid all that down the road. I mean, you put a process in place. We have a second set of eyes, always check sales tax payments every single time now. But having that celebration almost of the mistakes, mm-hmm. We're implementing some sales processes right now, and I'm when I go on sales calls, I'm literally like, okay, guys, what did I do wrong? How do we make that better? Mm-hmm. I mean, this felt good, but I stumbled here, and not being afraid to be vulnerable. Yeah. That's
powerful. I think when you, as the founder and president and CEO, set that example, that I'm sure ends up trickling down through everybody else. They're going to tend to follow that lead, right?
Well, when the boss makes a lot of dumb mistakes, you better learn from them.
So this best mistake award, that's a different way of saying, in a way, a favorite mistake.
Yeah. We stopped doing it after about 6 months because my managers are like, you're incenting the wrong behavior. Let's do it another way. So we set up a Slack channel or some kind of, thing to lessons learned, and we built it into the culture. And we have another thing in Insperity to us was kudos at GrowthForce, that kind, when you learn from somebody, or a client says something right, or somebody does anything that's furthers our core values. They help a teammate that they didn't have to, or they go above and beyond, they're accountable. You send an email out to everybody that just to the management team, kudos at growthforce.com. And then we celebrate those at the company meeting, and we have the teams go up and talk about, the lessons that they learned, or the, so that's a real cheap, easy way to get some employee validation and recognition. That's really valuable.
Well, so yeah, even without the award, that communication, like you said, the open, honest communication, that's still a great habit. And one of my other guests in the series, Bob Rush, who has a background in manufacturing like I did originally, he also talked about a similar thing. He worked for an organization that had a award for the best mistake, and they had that same discussion like you're talking about, and he convinced them to keep the award going because he said, well, what the award does is it doesn't increase the number of mistakes, it increases the honesty about the mistakes that are already there. So that's something that could be debated and discussed, but I think to me what sounds like the important thing is that you kept the communication going. That was probably more important than having a prize.
Totally, yes.
So really appreciate you sharing that story and that reflection, Stephen, on top of everything else that you've shared today. So, as we wrap up, again, we've been joined by Stephen King, President, Founder, CEO of GrowthForce. Stephen, if people want to learn more about your company and what you do, especially if they fall in that profile of companies you serve, how can they learn more?
Sure. Email is the best way to reach me. It's Stephen, Stephen, at growthforce.com, or you can reach us at www on the website is www.growthforce.com. That's GROWTH force.com. And I've got a podcast called Path to Profit. So, we kind of talk to people and share their secrets on how they increase their profitability. And I'm Stephen King CPA on LinkedIn, and S King GForce at Twitter. And there's no litter account that I know of.
Yeah, you just invented a new social media platform. Exactly what we don't need. But Stephen, thank you. This has been a lot of fun, and I hope people will I'll go check out Paths to Profit podcast. See, when you're reaching podcast listeners here, that's a good way to not convert them, but to have them also listen to your podcast.
Thanks, Mark.
Thank you, Stephen.